Definition, components, and formula of customer acquisition cost, CAC. What is CAC? It is the total amount of money a firm spends to convince one new customer to buy its product or service. Think of it as the price of bringing a new guest to the party. Main components: marketing expenses, ads, content creation, SEO, events, sponsorships, etc. Sales expenses, salaries, commissions, travel, CRM tools, demo costs. Overhead allocated to acquisition, a portion of rent, utilities, and administrative support that directly supports the acquisition function. Formula: CAC equals total marketing cost plus total sales cost plus allocated overhead divided by number of new customers acquired. If a S company spent $200,000 on marketing and $100,000 on sales in a quarter and signed up 1,000 new customers, CAC equals 200,000 plus 100,000 divided by 1,000 equals $300 per customer. Calculation of CAC using cohort analysis and time-weighted averages. Why cohort analysis? Customers do not all arrive at the same time. By grouping them into cohorts, for example, customers who joined in January, we can see how acquisition cost changes month to month and avoid the distortion caused by seasonal spikes. Step by step. Step 1. Identify cohorts, usually by month or quarter of first purchase. Step 2. Track all acquisition-related spend for each cohort. Include the marketing and sales spend that directly influenced that cohort. Step 3. Count the number of new customers in the cohort. Step 4. Compute cohort-level CAC, spend divided by customers. Step 5. Time-weighted average. Because early cohorts have more historical data, weight each cohort by the length of time it has been active. Mathematical expression: CAC sub TW equals the sum from C equals 1 to C of W sub C times CAC sub C divided by the sum from C equals 1 to C of W sub C, where W sub C is the weight for cohort C. For example, number of months the cohort has been observed. Example: January cohort, $50,000 spend, 250 customers, CAC equals $200, wait 12 months. February cohort, $45,000 spend, 225 customers, CAC equals $200, wait 11 months. And so on. The time-weighted average smooths short-term fluctuations and gives a more reliable CAC figure for forecasting. Relationship between CAC, customer lifetime value, CLV, and payback period. Customer lifetime value, CLV, is the net profit a company expects to earn from a customer over the whole relationship. CLV equals open parenthesis average revenue per user, a RPU, times gross margin close parenthesis times average customer lifespan. Payback period tells us how long it takes for the revenue generated by a new customer to cover its acquisition cost. Payback period in months equals CAC divided by monthly contribution margin per customer, where monthly contribution margin equals a RPU times gross margin. Key relationship: healthy business rule. CAC should be a fraction, often 1/3 to 1/5, of CLV if CLV equals $1,200 and CAC equals $240. The ratio 5:1 is considered safe. Shorter payback period, for example less than 12 months, reduces cash flow risk. Imagine you buy a vending machine for $240 CAC that generates $20 profit each month, monthly contribution. You will recover your investment after 12 months, the payback period. Determinants of CAC: channel mix, sales cycle length, and economies of scale. Channel mix: different marketing channels have different costs and conversion rates. Paid search: high intent, higher cost per click but often lower CAC. Social media: cheaper clicks but lower conversion, potentially higher CAC. Referral programs: low cost but depends on existing customers. Adjusting the mix changes the weighted average CAC. Sales cycle length: longer cycles mean more touch points, more salesperson time, and higher costs. B2B enterprise sales may take 6 to 12 months, leading to higher CAC. B2C impulse purchases may close in minutes, leading to lower CAC. Economies of scale. As the volume of spend grows, marginal cost often falls. Bulk media buying discounts. Automation, for example, email drip campaigns, reduces per lead sales effort. The CAC curve typically shows a steep decline early, then flattens. CAC equals the sum from I equals 1 to n of cost I times reach, I divided by the sum from I equals 1 to n of conversions I. Marketing ROI definition, formula, and interpretation in strategic decision making. Marketing ROI measures the financial return earned for each dollar spent on marketing. Marketing ROI equals open parenthesis incremental revenue attributed to marketing minus marketing cost close parenthesis divided by marketing cost multiplied by 100%. Incremental revenue equals total revenue after the campaign minus a baseline. What would have happened without the campaign? A positive ROI greater than 0% indicates the campaign added more money than it cost. A strategic interpretation. High ROI indicates allocate more budget, potentially scale the campaign. Low or negative ROI indicates pause, redesign, or shift, spend to higher return channels. ROI also helps compare very different activities, for example, a TV spot versus a content marketing series, on a common financial basis. Real-world analogy: if you spend $10 on a lemonade stand advertisement and sell $30 worth of lemonade because of it, ROI equals open parenthesis 30 minus 10 close parenthesis divided by 10 equals 200%. You made $2 for every dollar spent. Attribution decides which marketing touchpoints get credit for a conversion. First touch attribution, all credit goes to the first interaction. Useful for brand awareness campaigns. Last touch attribution, all credit goes to the final interaction before purchase. Common in e-commerce, where the last click is often a direct visit. Multi-touch attribution distributes credit across multiple touches. Linear equals share to each touch. Time decay, more weight to touches closer to conversion. U-shaped, heavy credit to first and last, lighter to middle. Why it matters for ROI. The ROI you compute depends on how you assign revenue to each channel. A single touch model can overstate or understate ROI, leading to misguided budget decisions. Example: a buyer sees a Facebook ad first touch, reads a blog post middle, and finally clicks a Google paid ad last before buying. In a linear model, each channel gets 1/3 of the revenue. In a last touch model, only Google gets 100%. Integrating CAC and marketing ROI in budget allocation and portfolio optimization. 1. Calculate CAC per channel using the formulas above. 2. Compute marketing ROI per channel. 3. Compare channels with low CAC and high ROI are prime candidates for increased budget. 4. Portfolio optimization. Treat each channel as an asset. Use a simple budget allocation equation. Budget sub I equals ROI sub I divided by sum from J equals 1 to n of ROI sub J multiplied by total marketing budget. Adjust for strategic constraints, for example, minimum spend on brand awareness even if ROI is lower. 5. Iterate after reallocating. Recompute CAC and ROI to see the impact. Analogy: imagine you have a basket of fruits channels. You want the most apples, high ROI, for the same weight budget. You remove some bananas, low ROI, and add more apples while still keeping enough oranges, brand building for taste. Sensitivity analysis and scenario planning for CAC and ROI under market uncertainty. Sensitivity analysis assesses how changes in key inputs affect CAC and ROI. Key variables: cost per lead, conversion rate, average order value, churn rate. Method: vary each variable by plus minus 10 to 20%, while holding others constant and observe the impact on CAC and ROI. Scenario planning creates coherent storylines. Base case: current market conditions. Optimistic case: higher conversion, lower media costs. Pessimistic case: increased competition, higher churn. Example table simplified. Scenario: cost per lead, conversion rate, CAC, marketing RO. Base $30, 5%, $600, 120%. Optimistic $25, 6%, $417, 180%. Pessimistic $35 4%, $875 60%. Managers use the spread to decide how much risk to take when increasing spend. Explanation: common exam questions: deriving CAC, computing ROI, and evaluating trade-offs between CAC and CLV. 1 period deriving CAC. Question: a company spent $150,000 on digital ads, $80,000 on sales salaries, and $20,000 on marketing software. It acquired 2,500 new customers. Calculate CAC. Answer: CAC equals 150,000 plus 80,000 plus 20,000 divided by 2,500 equals $250 per customer. 2 period computing marketing ROI. Question: a campaign cost $40,000 and generated $120,000 of incremental revenue. Gross margin is 50%. What is the ROI? Answer: incremental profit equals 120,000 times 0.5 equals $60,000. ROI equals 60,000 minus 40,000 divided by 40,000 times 100% equals 50%. 3 period evaluating CAC versus CLV trade-off. Question: CLV equals $1,200. Current CAC equals $300. Management wants to cut CAC by 20% even if it reduces conversion rate, which would lower CLV to $1,050. Should they proceed? Answer: new CAC equals $240. New CLV/CAC ratio equals 1,050 divided by 240, approximately 4.38, still above the common 3 to 5 rule, so the trade-off is acceptable. However, examine the impact on overall volume because a lower conversion rate may reduce total customers. 4 period scenario-based CAC. Question: using cohort data, Jan cohort CAC equals $200 weight 12. Feb cohort CAC equals $220 weight 11. Compute the time-weighted CAC. Answer: 200 times 12 plus 220 times 11. Divided by 12 plus 11 equals 2,400 plus 2,420. Divided by 23, approximately $210. These types of questions test both procedural calculations and strategic reasoning, exactly what MBA programs expect.